No one's talking about it, but central banks are choosing possession over price smoothing. Yes, it's not just the taxpayers' organization in Europe that wants the physical gold back. It's also all the global south countries. It's also China, Russia. It's also Poland and others that want physical. They don't buy futures. And I would venture to say that the smart money in the US and Europe, they're buying physical as well. And that's completely unraveling the paper market, not just on COMEX, but in the LBMA. Is it any wonder we had a 4 to 8 week delay for spot delivery at the end of January? And I spoke about that.
Despite the increase of global tensions, particularly in Eastern Europe and the Middle East, the US dollar is once again suffering pressure and ongoing volatility. Investors are reevaluating their portfolios and moving away from fiat currencies and into safe haven assets like gold and silver as a result of the increased level of global uncertainty. Mario Innecco asserts that this change is about preserving purchasing power in a world where central banks continue to print large amounts of money and expand debt, not just about short-term price action. Due to either a shortage of supply or skyrocketing costs, Innecco cautions that the day may come when it becomes very impossible to obtain actual gold or silver. He emphasizes that protecting physical assets before systemic dangers manifest is more crucial than listening to daily market noise. His worries are supported by recent data from the World Gold Council, which shows that central banks have been purchasing over 1,000 tons of gold a year for 3 consecutive years, more than twice as much as the average of 400 to 500 tons for the preceding 10 years. Remember to click the subscribe button and enable notifications to ensure that you never miss our most recent analysis. Thank you and enjoy the video.
It's another reason why you always hear people talking about, oh, gold is volatile, you don't get involved. But this is all changing now. There's another article here, which I told you about on LinkedIn by this guy called Peter Borgia. I'm not sure how you pronounce that. He's sounds like a Dutch name, but he's based in Dubai and he's in the gold market. And he recently posted this, and I'll go through it. He says, gold isn't just consolidating, it's cornering the paper market. So you see, it's the futures market, which the dealers talked about in 1974, which would negate long-term hoarding, is crumbling. So this is what he means, cornering the paper market. It means that paper market is just basically on its last legs. He says, while the media fixates on prices, yes, we always focus on prices, right? The real story is in deliveries. Since Trump's re-election, 817 tons of gold and 8,550 tons of silver have been stood for delivery on COMEX. Not trades, demand for metal. But COMEX net warehouse deliveries covered just 645 tons of gold and 7,146 tons of silver. That's a shortfall of 1,400 tons of silver in the physical market, slowly bleeding out. Silver looks volatile, but it's not noise, it's friction. No one's talking about it, but central banks are choosing possession over price smoothing. Yes, it's not just the taxpayers' organization in Europe that wants the physical gold back. It's also all the global south countries. It's also China, Russia. It's also Poland and others that want physical. They don't buy futures. And I would venture to say that the smart money in the US and Europe, they're buying physical as well. And that's completely unraveling the paper market, not just on COMEX, but in the LBMA. Is it any wonder we had a 4 to 8 week delay for spot delivery at the end of January? And I spoke about that. That was a really important milestone. Even the Bank of England's vaults have seen withdrawals that might not come back. At Iona, we don't just study price. We study what people settle when no one's watching. What happens when gold stops trading and starts vanishing. Steve Hanke, Professor Hanke, Steve Hanke, professor of applied economics at Johns Hopkins, he posted yesterday, gold is leaving the vault, COMEX inventories are falling, demand for physical gold is exploding, buy gold, wear diamonds. Yeah, that's an old terminology in the markets, especially in the futures and commodities markets, which I worked in. And I think Professor Hanke, he did trade the commodities markets years ago. So yeah, that's an interesting one. Buy gold, wear diamonds. So just one more thing before we look at the markets. I just saw a post here from Weimar Silver Baron. It says Iran is now calling on other Middle Eastern countries to sell U.S. treasuries. And there's a headline here, your treasuries pay for the bombs. Get out while you can. Am I pro-Iranian or pro-anything? No, as I've said many times in the past. But I've also told you in the past that by holding government bonds, you're financing governments. If you are okay with the U.S. bombing Iran, go ahead and buy treasuries. But if you're not, don't buy it. And the same thing goes for UK government bonds or gilts. If you are happy with what the government is doing here, go ahead and buy gilts and be ripped off. That's what happens when you buy bonds and they're inflating the money supply. But if you're not, yeah, don't buy gilts. Buy real physical money, i.e. gold and silver for that matter. So I expected to see quite a lot of volatility, and I admit I've been wrong. We're not perfect, right? The markets last night, London time, they did open down. The stock market, they were down about 0.5%, maybe a little more. But as that gentleman from LinkedIn was saying, people worry too much about prices, right? Think of the long game. The long game is that you want to have physical. And there will be one day where it will be really hard to get both physical gold and silver.
When Germany repatriated gold bars valued at around $31 billion that had been kept in storage in New York and Paris since the conclusion of World War II, it made news back in 2017. This action demonstrated how crucial it is for nations to directly manage their own gold stockpiles. European nations are now under pressure to repatriate their gold due to escalating geopolitical tensions and mounting criticism of the Federal Reserve, particularly from former President Donald Trump. Mario Innecco claims that calls for Germany and Italy to repatriate an estimated $245 billion worth of gold that is still stored in the United States are growing, as confidence in long-standing financial connections appears to be eroding. Now, let's watch more clips from the interview.
And by the way, it's just gone past 8 a.m. London time. It says Germany and Italy press to bring $245 billion of gold home from the U.S. And it says here, Trump's attacks on the Fed and growing geopolitical risks reignite public debate about repatriating bullion. And I'm gonna also refer to President Biden. And of course, the official narrative is that people don't really know who blew up Nord Stream 2, that it was probably some Ukrainian agents, but there's that Pulitzer Prize winning journalist, I forgot his name now, American, Seymour Hersh, who basically proved that it was the Biden administration who organized the blowing up of Nord Stream 2, which is a German asset, supposed to be one of your closest allies. But in reality, America's allies are America's minions, right? Empires never have allies, they have minions. But anyway, enough of empire bashing. Let's go through this article. It says Germany and Italy are facing calls to move their gold out of New York following President Donald Trump's repeated attacks on the U.S. Federal Reserve and increasing geopolitical turbulence. Yeah, I think those factors are both really important. Fabio De Masi, a former Die Linke MEP who joined the left-wing populist BSW party, told the Financial Times that there were strong arguments for relocating more gold to Europe or Germany in turbulent times? Well, there's the old saying, he who has the gold, has the power, right? It's interesting. It's funny that Fabio De Masi, I started reading that and I thought it was an Italian, but he's actually German. Anyway, Germany and Italy hold the world's second and third largest national gold reserves after the US, with reserves of 3,352 tons and 2,452 tons respectively, according to World Gold Council data. Well, in the US, we don't even know actually how much gold they have. Just like the Epstein files and the JFK files, these things were supposed to be released. There's a call for an audit. Even Donald Trump, President Trump, came out and said, we don't think we have our gold, but that's gone out the window. There's only one guy who's now public enemy number one for Donald Trump, Thomas Massey, who wants to see an audit. He's of course someone who also wants to see the Fed abolished. So there you go. I think Thomas Massey has been a big winner of the current crisis, especially in the last few days. He's become very popular, and it's a good thing. He's a constitutionalist. Both rely heavily on the New York Federal Reserve in Manhattan as a custodian, each storing more than a third of their bullion in the US. Between them, the gold stored in the US has a market value of more than $245 billion, according to FT calculations. I mean, this would be a massive blow to the US banking system, to the Federal Reserve. Of course, you read through here, there's the usual comments from the Bundesbank, the German central bank, that they still trust the New York Fed, and so on and so forth. One of the major Maloney's party, political party, who a few years ago, before she came to power, was pushing for the gold to come back. They're being very coy, but
Mario Innecco's statement essentially demonstrates that nations are realizing the importance of a timeless yet potent lesson. While verbal guarantees, political connections, and paper promises can vanish in an instant, real security lies in having gold in a vault inside your own boundaries. Mario is telling the audience that confidence in international banking systems is waning by showcasing Germany and Italy's renewed efforts to bring their gold home. Countries used to trust organizations like the Federal Reserve to protect gold, and they accepted the ease and security of holding it overseas. However, trust is eroding as a result of increased geopolitical tensions, unforeseen confrontations, and growing mistrust, whether brought on by the ongoing devaluation of currencies, the explosion of pipelines, or the loss of central banks' independence. Both individuals and governments are coming to the realization that, in times of crisis, what matters most is what you can physically hold and control, not what is reported on a balance sheet or kept on the other side of the globe. Mario warns that the paper system, which depends on more claims than actual metal, may begin to fall apart as more nations demand physical delivery by relating this to the futures market. The financial system will be under tremendous strain, and its fragility will be shown if enough central banks demand their gold back. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.